Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Okay, we have to talk about NextNRG, ticker NXXT, because what we're seeing right now is a masterclass in conflicting forces. We're watching a very, very aggressive battle right around that critical $1.48 pivot point. If it breaks down from there, major support is, well, it's sitting near 133. But the real prize, the signal for a real trend reversal, is up towards 192. And what really complicates this whole picture is the volume structure. It's extreme. The dark pool volume is consistently over 50%, 51.30% to be exact.
And that volume dynamic, that's the core of the problem, isn't it? We are looking at a microcap where the financial reality and this explosive operational story they're completely disconnected from one another. On one hand, yes, NXXT has managed this radical pivot, trying to shed its old low-margin logistics past as EasyFL and, wrap itself in this premium AI-driven energy innovation narrative. But that story is constantly at war with, frankly, an existential financial crisis.
And that's the duality, right, that defines our whole conversation today. The central question for NXT is really this. Does the company's staggering operational success, and you can't dispute the hypergrowth in volume and revenue, does that validate the market giving it a premium tech valuation? Or is this stock just structurally doomed by its balance sheet and its financing tactics? I'm going to argue that the narrative, the velocity, the execution, it's all overwhelmingly positive. The market is just mispricing this thing based on its history.
And I'm going to argue that the structural fragility is what dictates the future here. The stock is, and I think will remain, a high-risk trading instrument. It's defined not by its dreams of smart microgrids, but by its crippling solvency issues, and honestly, its dependence on continuous, aggressive shareholder dilution.
All right, let's start with the hard evidence then. Let's start with execution and why the market should be excited. The operational numbers are, I think, definitive proof of a successful pivot. Preliminary revenue for October 2025, $7.39 million. That is an astonishing 196% year-over-year increase. And that's on the heels of a September that saw a 229% year-over-year surge. This is not gradual growth. This is hypergrowth. It really suggests the company's next utility operating system is hitting critical mass. And the rebranding, the AI and smart microgrids, the partnership with Florida International University, look, those are not just PR stunts. They are effective moves toward sector rotation. They're actively aligning NXXT with the highest premium trends in the market right now, energy resilience and the AI premium. So this trajectory, it justifies aggressive speculation. And technically, if we can just confirm a breakout above 192, we could be looking at a powerful reversal that takes us towards that $2.52 resistance level pretty quickly.
I see why you emphasize those top-line numbers. I do. They're undeniable proof that the business is generating activity. But when you look beneath the hood, you find that this operational success is, it's being subsidized by compromising the company's structural integrity, and the market has to value solvency above all else. NXXT isn't defined by its $7 million in monthly sales. It's defined by a liquidity crisis.
Okay.
Let's just look at the actual financial metrics from the end of September 2025. Their cash position was only about, $653,000? For a company bringing in over $7 million in a single month, that cash balance it's dangerously tight. But the most alarming number, the one that really matters, is the working capital deficit. It's nearly $30 million. $29.97 million to be precise. That means they owe almost $30 million more in short-term bills than they have in assets to cover them. That forces them into this continuous cycle of financing.
That deficit is substantial, I'll grant you, but isn't it just a temporary lag? The growth is exponential.
The problem is the crisis is immediate, not prospective. The most critical data point for any analyst here is management's own disclosure, the going concern qualification. That is the clearest signal possible that the company is dependent on continuous, aggressive equity financing just to keep the lights on, just to sustain those operations that you're celebrating. They are literally operating on borrowed time and borrowed capital. And when you pair that with the structural headwinds, specifically the cumulative 1-for-20 reverse split history, that history creates a massive overhang of bag holders. Anyone who bought this a year ago at $1 now needs the stock to hit $20 just to break even. Any spike just becomes an exit opportunity for a huge layer of trapped sellers. It's the definition of a dilution death spiral.
That historical baggage is heavy. I get that. But let's really tackle this paradox head on. The operational execution suggests this liquidity crisis is a solvable, temporary problem, not a permanent death sentence. The success is just too staggering to dismiss. They scaled deliveries from 1.9 million gallons in Q3 2024 to 6.5 million gallons in Q3 2025, a threefold increase in volume. That is powerful evidence that the logistics platform is working and that they're moving toward the critical mass they need for profitability. This expansion is the long-term mechanism to generate the cash to cure that deficit. So why call it a death spiral if the engine is so clearly accelerating?
Because the structural reality doesn't afford them the luxury of a slow organic cure. I'm sorry, it just doesn't. That $30 million deficit, it necessitates immediate capital, which is why we see them constantly using the $60 million out-the-market offering, the ATM. This ATM facility represents a potential dilution of roughly 24% of the current market cap? It creates a perpetual hidden seller in the market.
Right.
And this isn't theory. We see it in the trading action. Every single time retail enthusiasm creates a spike, that supply is just being dribbled out into the market by the ATM agent, and it overwhelms the demand. That explains a consistent pop and drop dynamic we keep seeing. So I'd argue the revenue growth, while real, is only keeping the balance sheet on life support by providing these brief little windows for the ATM to sell shares. The growth isn't curing the dilution. The dilution is funding the growth.
That's an interesting way to put it, that the growth is conditional on the dilution. Okay, let's move to our second major point, how we interpret signals from the insiders. If the situation were truly existential, you'd think we'd see panic.
Well, let's start with the clearest warning sign of insider sentiment then. Director Daniel Arbor, he sold 93,859 shares between $1.25 and $1.31 on December 16th. And crucially, this happened immediately after the release of that bullish Q4 guidance you were celebrating. That is a significant fundamental warning. It suggests at least one key insider sees good news not as a reason to hold, but as a fleeting opportunity, a liquidity event to exit. That timing, it severely undermines the whole AI and hypergrowth narrative.
That's a compelling point on Arbor's sale, but I would frame the CEO's action differently, and I believe his commitment is the stronger signal. Look at the September debt-for-equity swap. The company issued 1 million restricted shares to CEO Michael Farkas to settle a $1.67 million debt. So this action valued those shares at about $1.67. By accepting stock instead of cash, stock he can't easily sell, he's locking his capital in and setting a valuation anchor well above the recent floor. That's a clear alignment with shareholders. And on top of that, look at the cost to borrow. It's at 21.13%. That's getting expensive for shorts, which tells you the market is starting to price in risk to the bear thesis.
A rising cost to borrow is a factor, sure. But in a market where the company is continuously injecting fresh supply through the ATM, the cost of borrowing becomes less relevant than the sheer volume of available shares. That supply acts as a buffer against any squeeze, which brings us to the third core point. The market structure and the price discovery in this stock are fundamentally impaired.
I don't think it's fundamentally broken. It's complex, yes. The reported 6.32% short interest, combined with that 21% cost to borrow, it strongly suggests the prerequisites for a technical AI squeeze are there. We've seen retail buying, catalyzed by those AI keywords, try to trigger this, and we have to watch the NASDAQ threshold list. Persistent failures to deliver, FTDs, could land NXXT on that list. That's where the T+35 theory comes in. It suggests that persistent FTDs could trigger a forced buy-in event, putting non-discretionary pressure on short sellers. With a tight float, even a modest retail push could trigger a very disproportionate move up.
That's an interesting case for a technical trigger, but the high dark pool volume, that 51.3% figure you mentioned at the start, is precisely why a retail-led short squeeze is so hard to pull off here. The price discovery on the lit exchange is it's heavily impaired. Think of it like a vacuum cleaner. When retail buyers jump in, market makers internalize that order flow off exchange. It just gets absorbed. This neutralizes the buying pressure before it ever hits the public tape where the shorts would feel the pain. The volume of supply being dribbled out from that $60 million ATM is the dominant force here. It completely outweighs the mechanics of short covering. The skepticism you see in retail forums about the split, dilute, drop cycle, that's not baseless cynicism. It is structurally sound skepticism.
I appreciate the reality of those headwinds. The ATM, the dark pools, they certainly cap explosive upside. I agree. But you can't ignore the narrative velocity. This company successfully pivoted from being valued on its physical assets, its tanker trucks, to being valued on the potential of its next utility operating system. That shift alone, validated by 196% growth, deserves a serious re-rating from the market, even if the financing has been aggressive. The technical setup, showing that reversal potential above 192, it suggests a significant part of the market is trying to look past the current solvency issues.
Or the market is forced to look past them because the company is actively selling its future to pay for its present. You can't sustain a high-growth narrative forever if the foundation is financed by destroying shareholder value through dilution. That 1-for-20 split history, it just looms over everything, preventing any sustainable rally because there's always a layer of trap sellers waiting for an exit. The operational volume is impressive, yes, but it's just a necessary condition for survival. It's not a sufficient condition for a long-term viable investment. The market correctly sees this as a vehicle for extreme volatility trading, where timing the news is far more critical than believing in the vision.
So our discussion has really shown that NXXT is this almost perfect duality. On one side, you have aggressive operational expansion, that 196% growth, the $7.39 million in monthly revenue, all driven by this successful narrative pivot. But it's all held in check by this profound structural fragility, the nearly $30 million deficit, the punitive 1-for-20 dilution, and the constant ATM supply being absorbed off exchange.
Exactly. It's a true battleground stock, where the operational success is just enough to pay the bills, but the financial fragility dictates the volatility and ultimately the price ceiling.
I still maintain that the narrative management and that explosive growth make NXXT a viable high-risk, high-reward trading vehicle. For an aggressive speculator, that technical breakout opportunity above 192 presents some really significant potential upside.
And I still contend that the fundamental reality, the going concern risk, and the constant dilution makes this stock too structurally compromised for any kind of sustainable long-term investment. It really does confirm its status as a trader's hotel, where you have to be very, very careful about the checkout time being imposed by that perpetual dilution.
Well, assessing a complex microcap like this clearly requires looking at both the powerful narrative and the cold, hard structural risks at the same time. Further exploration, including, as you said, monitoring to see if NXXT appears on that NASDAQ threshold list, will continue to illuminate its likely path forward.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.